that more and more people would fear for their jobs and the saving rate would go up. Why has this not happened? Well, one of the reasons is there are a lot of people living hand to mouth out there, so it's not possible for many people. But for higher income consumers, what has happened in the last few years? Well, the stock market has continued to go up, and home prices have gone up. They have not gone down, even though so many other measures of housing have collapsed. The pricing is up there. I think it's up there because the market isn't clearing, and we'll go into that in a moment.
Hey guys, welcome to Everyday Finance. When the market finally calms down and the hubbub subsides, Bitcoin stealthily takes back the limelight as a respectable foundation of contemporary finance, rather than as a speculative wager. While some of the Magnificent Six are struggling to maintain momentum and tech companies are chasing the next buzzword, Bitcoin is gaining more traction. It's math this time, not hype. With the use of institutional portfolio theory, Cathie Wood and her Ark Invest team have calculated the potential of Bitcoin, estimating a base scenario of $1.5 million per coin and an astounding $3.8 million if institutions allocate optimally. Before you see the facts, it may seem extreme, but Bitcoin is evolving into a fundamental asset that improves portfolio efficiency, boosts long-term returns, and lowers systemic risk. The focus now is on essential infrastructure rather than alternative investment. The silent incorporation of Bitcoin into the framework of international finance is what's happening, not just another crypto frenzy. Those who continue to argue over its appropriateness are already lagging behind.
The U.S. government is effectively, for the most part, shut down. And lest you worry, and this has been all over the media, it is very interesting to know that the stock market usually goes up while the government is shut, for whatever reason. Anyway, we do have a lot of statistics to discuss. I think since the last In the Know, we got the huge revision in employment. It was 911,000 jobs fewer in March 25 than had been originally reported. So we had been showing you consistently monthly revisions which were down. And of course, the total was almost 1 million. The Fed did cut the Fed funds rate by 25 basis points. They are still balancing between inflation, which once again seems stuck because tariffs are working through, so stuck in the 2.5% to 3% range for the most part, against employment, which is beginning to deteriorate. We did get this week the ADP payroll report. This is from the private sector, and the number there was -32, and perhaps more important, the previous month was revised down from +52 to -3,000. That's unusual in the ADP survey. So employment is weakening, and probably more significantly than we understand. There are a couple of reasons here. One, of course, is cyclical. Employment is a lagging indicator. We've been talking about a rolling recession for the past 3 years, and we've started moving past that in terms of at least our understanding of what is unfolding, into the thought that we may be going into a rolling recovery, which we think next year will evolve into a productivity-driven boom in activity, just in time for the midterm campaign election season. I don't think that is a coincidence. I think the Trump administration has taken or given a lot of tough medicine very early in its term, and that it is looking forward to a very exciting next 3 years. But the Fed is grappling here. Employment down, inflation sticky, and so we're once again in that are they or are they not going to cut rates again? We think they will. And one of the other reasons is not only is private employment falling, but we know government employment is falling. And we believe between now and the end of the year, another 150,000 jobs will be lost in the federal sector. And it could be even more than that, because with this shutdown, it seems like the administration is doing more, I think, what it would call house cleaning, to increase the efficiency of government and get spending under control. So that's the big picture. I will now go into the usual drills, so fiscal policy, monetary policy, economic indicators, market indicators, and weave in there a little bit about innovation, because innovation is causing a bit of a stir on the employment front. And our confidence that the deficit is going to diminish as a share of GDP to at least 3% of GDP, which is Treasury Secretary Bessent's objective by the end of the Trump term. If we're right, and the growth rate in the next 3 years is much stronger than anyone has forecast, we believe that the deficit could shrink to less than 3% as a percent of GDP. So that we think is good news. And we are seeing month to month now declines in the deficit very recently, as you can see on this chart. Now I'm going to bring up this next chart because having been through Europe and Asia in the last 5 weeks, it is very clear that the rest of the world has been influenced by headlines and drama and negative headlines, and they know nothing of the good news in what we are now calling OB3, the One Big Beautiful Bill. So in OB3, and I've shown you this chart before, but the more I think about it, the more provocative this is. So we have never in our history seen a policy where for manufacturing structures built in the United States during the next 3 years, or in the process of being built, depreciation will not be over 30 years, as it typically is. It will be 1 year, fully expensed. In fact, the government will be refunding a lot of companies for the manufacturing structures. They'll be getting refunds for how much they have spent relative to what has been expected to be their tax bill. So that is just for the next 3 years. The next 3, equipment, domestic R&D, and software, music to innovation's ears, those are also fully expensed in year 1. And these have been tried on and off by various administrations when they're trying to stimulate the economy in the short term. But they have never been legislated in to be permanent. And they are. And, I actually have to do a double take every once in a while. And for that reason, what you're seeing here is while the statutory tax rate will stay at 21%, that's, in fact, President Trump in his first term got that down from 35 to 21%. How he did that, I will never know, given the divide in government.
Due to the convergence of 5 potent technologies in every industry. Rather than a single discovery, the world is about to experience a new productivity boom. Innovation in healthcare, driverless vehicles, robots, and artificial intelligence are all accelerating at an exponential rate. Capital is moving toward the disruptive frontier, while established market leaders slow down. This is not typical growth. Rather, it marks the beginning of a more rapid and intelligent economic era in which invention fosters innovation. With aggressive tax incentives, governments are speeding up the transition and providing investors in revolutionary technology with a strong tailwind. However, the opportunity is still unequal. Ordinary investors are left out while billionaires have early access to private marketplaces. As the conversation highlights, the next phase is wiser inclusion, which includes creating more equitable institutions, increasing access, and enabling people to take part in the very technologies that are changing the world. The runway is wide open for those who are prepared to participate, and the future is no longer approaching slowly.
The quit rate has gone down, is going down, and is where it typically goes during a recession. People do not quit their jobs if they believe they will not be able to get another one. And the duration of employment, I think I have this in this pack here, the duration of employment, yes indeed, is going up. It's gone from roughly 20 weeks at its low recently to 25 weeks. But take a look at what's happened over time. There's something structural going on. The 20 weeks is where it used to peak. And in the early 80s, before we entered Reaganomics, or as we were entering, it bottomed at 10. So now it's bottoming at 20, so and moving to 25. That's a half year. So when a person loses a job, he or she, on average, has to wait almost half a year for a new opportunity. These are all averages, of course. This is not true for everyone. I do think this move towards automation is exacerbating this trend right now. And here you can see it in living color. So here is U.S. job openings. We did get this number. The job opening number continues to come down. But take a look at what happened after ChatGPT was released. We had been in, again, supply chain issues, tough to get labor back during COVID and after COVID. But now the number of job openings is continuing to decline. And normally when it has declined this much, we are in a recession. The counterbalance here, of course, is if companies are not hiring and are harnessing AI and other productivity enhancing tools, their margins are not suffering. And that is one reason capital spending, ex-AI, it has been weak, but it has not collapsed. So companies know they have to invest. So it's been a very interesting cycle, to say the least. Here is another surprise to us. Here's the personal saving rate, and you can see what happened during COVID. It rocketed to record highs, and then went almost immediately to near record lows. And we thought that as we moved through this rolling recession, that more and more people would fear for their jobs and the saving rate would go up. Why has this not happened? Well, one of the reasons is there are a lot of people living hand to mouth out there, so it's not possible for many people. But for higher income consumers, what has happened in the last few years? Well, the stock market has continued to go up, and home prices have gone up. They have not gone down, even though so many other measures of housing have collapsed. The pricing is up there. I think it's up there because the market isn't clearing, and we'll go into that in a moment.
The competition between equities and Bitcoin has changed from being about returns to being about relevance in the age of AI-driven acceleration. From the Dutch East India Company to Wall Street, stocks have been the foundation of global expansion for centuries. Fostering innovation and withstanding economic storms. However, the plodding, regulated structures of the traditional Stock market are beginning to appear antiquated as artificial intelligence speeds up innovation cycles. In contrast, Bitcoin is evolving at the same rate as technology. It was once written off as erratic and speculative, but AI is now revolutionizing it by improving mining performance, blockchain analytics, and transaction efficiency. In an era of limitless currency creation, its fixed supply creates scarcity, and its decentralized structure protects it from institutional fragility. In a bull market, Cathie Wood's Ark Invest predicts that Bitcoin may reach $1.5 million. And if institutions deploy wisely, it might reach $3.8 million. Systems that can grow, adapt, and self-optimize will be dominant as AI transforms banking. And inflexible business structures might find it difficult to keep up. Bitcoin is already merging with the future and isn't waiting to be adopted by conventional banking. Transparent, programmable, and intelligent assets will be the hallmarks of the new financial era. And Bitcoin is at the forefront of this movement.